Welcome back, Savvy Savers. Today, we're tackling a topic that impacts every aspect of your financial life: interest rates. Whether you're taking out a loan, opening a savings account, or using a credit card, understanding interest rates is crucial. They can be your best friend, helping you grow your savings, or your worst enemy, increasing your debt. So, let's dive in and decode the mysteries of interest rates to help you make smarter financial decisions. Interest rates are a fundamental concept in finance, affecting everything from your mortgage payments to the returns on your savings account. However, they can be confusing and intimidating. What exactly are interest rates? How are they determined? And most importantly, how do they impact your finances? By the end of this video, you'll have a solid understanding of interest rates and how to use this knowledge to your advantage. At its core, an interest rate is the cost of borrowing money or the reward for saving it. When you take out a loan, the interest rate is the cost you pay to borrow the money. Conversely, when you deposit money in a savings account, the interest rate is the amount the bank pays you for using your funds. Interest rates are typically expressed as an annual percentage rate, APR. This rate indicates how much interest you will earn or owe over the course of a year. Interest rates come in various forms, each with its own implications. Here are the most common types you'll encounter. 1. Fixed interest rates. These rates remain constant throughout the term of the loan or investment. They provide predictability and stability, making budgeting easier. For example, if you take out a mortgage with a fixed interest rate, your monthly payments will stay the same for the duration of the loan. 2. Variable or adjustable interest rates. These rates fluctuate based on changes in a benchmark interest rate, such as the prime rate or the LIBOR. While variable rates can start lower than fixed rates, they carry the risk of increasing over time. This can make your payments unpredictable. 3. Simple interest. This is calculated on the principal amount of a loan or investment. It's straightforward and easy to understand. For instance, if you invest $1,000 at a 5% simple interest rate, you'll earn $50 annually. 4. Compound interest. This is calculated on the principal amount as well as any interest that has already been added to it. Compound interest can significantly increase the amount you earn on savings or owe on loans over time. The frequency of compounding, daily, monthly, quarterly, or annually, also affects the total interest. Interest rates are influenced by a variety of factors, both economic and individual. Here's a closer look at some of the key determinants. Firstly, central bank policies. Central banks like the Federal Reserve in the United States set benchmark interest rates that influence the rates offered by commercial banks. When the central bank raises rates, borrowing becomes more expensive and saving becomes more attractive. Secondly, inflation. Inflation erodes the purchasing power of money. To combat inflation, central banks may raise interest rates to cool down an overheated economy. Conversely, during periods of low inflation, they may lower rates to stimulate spending and investment. Thirdly, economic conditions. Economic growth, employment rates, and consumer confidence also play a role in determining interest rates. A strong economy typically leads to higher interest rates, while a weak economy may prompt lower rates to encourage borrowing and investment. Fourthly, creditworthiness. On an individual level, your credit score and financial history significantly impact the interest rates you're offered. Higher credit scores generally result in lower interest rates because they indicate lower risk to lenders. Lastly, loan terms. The length and type of loan can affect the interest rate. Short-term loans often have lower rates than long-term loans. Additionally, secured loans, backed by collateral, typically have lower rates than unsecured loans. Interest rates play a crucial role in determining the cost of various types of loans, including mortgages, auto loans, student loans, and personal loans. Understanding how interest rates affect these loans can help you make better financial decisions. For mortgages, For most people, a mortgage is the largest loan they will ever take out. The interest rate on your mortgage affects your monthly payments and the total amount you'll pay over the life of the loan. Even a small difference in interest rates can add up to thousands of dollars over a 30-year mortgage. Fixed-rate mortgages provide stability with consistent payments. They are ideal if you plan to stay in your home for a long time and want predictable payments. Adjustable-rate mortgages, or ARMs, start with lower rates that can increase over time. They might be suitable if you plan to move before the rate adjusts or if you anticipate interest rates will decrease. For auto loans, the interest rate on an auto loan affects your monthly payments and the overall cost of the car. Shop around for the best rates and consider making a larger down payment to reduce the loan amount and interest paid. For student loans, interest rates on student loans can be fixed or variable. Federal student loans usually offer fixed rates, while private loans might offer variable rates. Understanding the terms can help you manage repayment and save money. For personal loans, these can be used for various purposes such as debt consolidation, home improvements, or emergencies. Interest rates on personal loans vary widely based on your credit score, loan amount, and term length. Compare offers from multiple lenders to find the best rate. Interest rates don't just affect the cost of borrowing, they also impact the returns on your savings and investments. For savings accounts, the interest rate on a savings account determines how much your money will grow over time. Higher rates are better, but they often come with trade-offs, such as higher minimum balances or restrictions on withdrawals. For certificates of deposit, or CDs typically offer higher interest rates than regular savings accounts, but your money is locked in for a set period. Compare rates from different banks to find the best CD for your needs. For bonds. Bonds are essentially loans you make to corporations or governments. The interest rate or yield on a bond affects its price and your returns. Higher interest rates generally lead to lower bond prices and vice versa. For investments, interest rates can also influence the stock market. When rates are low, borrowing costs are reduced, which can encourage business expansion and increase stock prices. Conversely, high rates can slow down the economy and negatively impact stocks. Understanding how interest rates work allows you to make informed decisions that benefit your financial situation. Here are some strategies to consider. Firstly, consider refinancing loans. If interest rates have dropped since you took out a loan, refinancing to a lower rate can reduce your monthly payments and the total amount of interest paid over the life of the loan. Secondly, lock-in rates. For loans such as mortgages, you can lock in a fixed rate to protect yourself from future increases. This is particularly useful in a rising interest rate environment. Thirdly, shop around. Whether you're looking for a loan or a savings account, compare rates from multiple banks and lenders. Even a small difference in interest rates can add up over time. Fourthly, build your credit score. A higher credit score can help you qualify for lower interest rates on loans and credit cards. Pay your bills on time, reduce your debt, and avoid applying for too much new credit. Fifthly, invest wisely. In a low interest rate environment, consider investments that offer higher returns, such as stocks or real estate. Just be aware of the risks involved and diversify your portfolio. Lastly, take advantage of high-yield accounts. Look for high-yield savings accounts or money market accounts that offer better interest rates. Online banks often provide higher rates than traditional brick-and-mortar banks. Compound interest can significantly impact your savings and investments, but it can also increase your debt if you're not careful. Understanding how compound interest works is crucial for managing your finances effectively. Firstly, compound interest on savings. The magic of compound interest is that it allows your money to grow exponentially over time. The more frequently interest is compounded, like daily, monthly, or quarterly, the more you'll earn. To maximize your savings, look for accounts with high compound interest rates and frequent compounding periods. Secondly, compound interest on debt. On the flip side, compound interest can make your debt grow rapidly. This is especially true for credit cards and payday loans with high interest rates. To avoid falling into a debt trap, pay off high-interest debt as quickly as possible and avoid carrying a balance on your credit cards. To better understand the impact of interest rates, let's look at some practical examples. First, a savings account with simple interest. Suppose you deposit $10,000 in a savings account with a 5% simple interest rate. After 1 year, you would earn $500 in interest for a total of $10,500. Next, a savings account with compound interest. Now, let's assume the same $10,000 is in an account with a 5% interest rate compounded annually. After 1 year, you'd earn $500 in interest. But in the second year, you'd earn interest on $10,500, resulting in $525 in interest. Over time, this compounding effect significantly increases your earnings. Now, a mortgage loan. Imagine you take out a $200,000 mortgage with a 4% fixed interest rate over 30 years. Your monthly payment would be around $955. Over the life of the loan, you'd pay approximately $343,739, with $143,739 being interest. Lastly, credit card debt. If you have $5,000 in credit card debt with an 18% APR, carrying that balance for a year would cost you $900 in interest if you only make the minimum payments. This doesn't even include compound interest, which would make the debt grow even faster. Interest rates are a powerful force in the financial world, influencing both your borrowing costs and your investment returns. By understanding how they work, you can make informed decisions to benefit your financial health. Whether it's choosing the right loan, maximizing your savings, or investing wisely, knowledge is your best tool. Thank you for joining us today on this journey to understanding interest rates. If you found this video helpful, please give it a thumbs up and share it with others who might benefit from this knowledge. Don't forget to subscribe for more insights on managing your money and making smarter financial decisions. Stay informed, stay savvy, and take control of your financial future. Let us know in the comments, how have interest rates impacted your finances? What strategies do you use to manage them? Thanks for watching and see you next time.